Somebody just wiped out $50,000 of your debt, and you're sitting there feeling like you won the lottery. But what if the IRS is already printing your name on a bill? Welcome to one of the most misunderstood corners of the tax code, where your financial relief can quietly become a financial nightmare. Here's the thing. When a lender forgives your debt, the government doesn't see a favor, they see income. In the eyes of the IRS, money you borrowed and never paid back is essentially money you received. And money you receive is almost always taxable. Think of it like this. If your friend loans you $100 and then says, "Forget it," you're $100 richer than you were before. The IRS looks at canceled debt the same way a landlord looks at a vacant unit as an opportunity they're not going to let slide. Now, this didn't become a crisis overnight. It crept up on millions of Americans who refinanced, settled credit card balances, or walked away from underwater mortgages and thought the nightmare was finally over. Then January came, and so did the Form 1099-C, which stands for cancellation of debt, sitting in the mailbox like a plot twist nobody asked for. The catalyst behind all of this is actually a law from 1984 called the Deficit Reduction Act, which codified that forgiven debt equals gross income. Decades later, the IRS is still very much playing by those rules, even as the economic landscape has shifted dramatically around them. But here's where it gets nuanced, and where a lot of people throw their hands up in defeat too early, because there are real, legitimate exceptions carved out by law: bankruptcy discharges, insolvency exceptions, qualified principal residence debt, and certain student loan forgiveness programs can all shield you from that tax hit, and that distinction matters enormously. The insolvency exclusion alone is one of the most underused lifelines in the entire tax code, and most people have never even heard of it. If your total liabilities exceeded your total assets right before the debt was forgiven, you may be able to exclude some or all of that canceled amount from your taxable income. You just have to do the math and file the right form, which is Form 982. History shows us that whenever there's a wave of debt relief, the 2008 mortgage crisis, the COVID-era loan forbearance era, the student debt conversation, this same confusion resurfaces like clockwork. Millions of people get surprised by a tax event they didn't budget for, and financial advisors collectively sigh because the information was always there, just buried. There's also a persistent myth floating around that if you negotiate a settlement with a credit card company, say you owed $10,000 and they agreed to take $5,000, the forgiven $5,000 just disappears quietly. It does not disappear quietly. It shows up on a 1099-C. And ignoring that form is how people end up in a very uncomfortable conversation with the IRS 2 years later. The practical lesson here is simple. Before you celebrate any debt forgiveness, treat it like a mixed blessing and immediately ask 2 questions. Does this qualify for an exclusion? And if not, how much tax will I actually owe? Building that number into your financial plan before it arrives is the difference between being prepared and being blindsided. The actionable strategy is not to avoid debt relief, it's to pursue it intelligently, document everything, and work with a tax professional who knows the specific exclusions that apply to your situation. Discipline here doesn't mean fear. It means not letting one good decision create an unintended second problem. And philosophically, the broader lesson is that in personal finance, the details inside the fine print are almost always where the real story lives. Conviction without preparation is just optimism with a timer on it. You don't need to be afraid of debt forgiveness, you need to be ready for it, which means understanding the rules before the relief arrives and sizing your tax exposure the same way you'd size any other financial risk. The people who navigate this well aren't smarter, they're just more methodical. Whether you're dealing with a forgiven mortgage, a settled credit card balance, or a loan discharge, the framework is always the same. Identify the type of debt, check it against IRS exclusions, document your insolvency if applicable, and file correctly. Process beats panic every single time in this space. And if all of this has you thinking about your next smart financial move, whether that's real estate investing, home contracting work, or finding the right lenders to work with, check out our links in the description below, and let's get you started on the right foot.